Hi, I'm Dave,
And I'm Paul.
and we're going to challenge you to transform your financial future through the principles of the most profitable business in the world, banking.
We believe everyone should be involved in two businesses, the business that you're in and the banking business. Everyday people can replicate what bankers have been doing for centuries to leverage capital and build wealth through private lending.
Join us as we uncover the truths about money, expose lies and myths, and flip conventional financial advice on its head. Here we go. Well, hey, Paul, welcome back from Florida. How was that?
Dude, we missed you, man. It was nice to meet Chad and a few other folks for the first time. Mainly him, though.
Yeah.
And Marty, and just enjoy each other's company. Be around like-minded people. Be around people. You know, James was there, of course. Ryan. Met this guy DK. But it was nice to be around people doing it right. And when I say doing it right, I mean, IBC and in this business.
So you were down there for the leaders conference for one of the companies that we write business for. So
Yeah.
that means I don't know what that means as far as what percentage. Like Paul and I both qualified for an all expense paid trip to Florida at a really cool resort, 3 nights,
Really nice.
4 days. I unfortunately got called up for some military duty that I could not get out of for the second year in a row and missed the conference. So I was sitting in an office all week while you were out on the beach and being wined and dined. So congrats to you.
Yeah, thank you. No, the weather was great, and then Tammy and I, it was our anniversary week that week on the 13th, so we extended for a few days and just spent an extra couple nights at the hotel. And but
Nice.
yeah, super nice.
Awesome, man. Awesome. Well, I had a pretty eventful weekend. It started by proposing and getting engaged on a Friday afternoon. Thank you. And then spent all day Saturday and Sunday at a baseball tournament about an hour and a half from here. So it was a really fun time, though. I mean, you get down there with all the parents get to know each other better. All the boys get to hang out together and play ball and stay in a hotel room. And my son Blake hit a walk-off home run to put us in the championship game. So that was the highlight, and he did it on Father's Day. So that was pretty cool, pretty good gift.
Doesn't get much better than that.
No, man, it was great to see. It's just so fun to see those kids get better every game, every practice. Just so from where they started to where they are now, it's pretty unreal. But
No, that's awesome. Well, congrats, man, all around. I mean,
yeah, thanks.
Some big moves.
Some big moves, yeah, and big expenses coming up. But it's a good thing I have available capital to cover it.
Yeah.
Yeah.
Well, I can't wait to hear what a wedding costs nowadays.
Yeah, you don't want to know. Just avoid a second wedding. I'm sure you'll do that. So, or a third or fourth or whatever it may be for anybody else out there.
Yeah, roger that.
Yeah, but it'll be worth it. All right, well, let's get to it, man. Today we're gonna take a second hack at some questions from listeners, from clients, from you and I that we've collected over the last little bit of time. So we'll get through as many as we can here in the 30 minutes or so, and then we'll save some for next time. So, well, why don't I start asking you the first one, Paul? Is there a limit on how much I can put in to these policies?
Not like they're thinking, right? They're thinking, the person asks that question, right? And that question comes up a lot. They're thinking qualified plan. Like, hey, I can only put this much in a traditional 401k. I can only put $6,000 a year into a Roth or whatever.
Which is why they're asking, right? Because they're used to having limits, IRS limits imposed. Right.
That's right. They're programmed to think like this. Oh, I can only do this, right? Because the gracious master only lets me put that much in. So for a whole life insurance, the answer is yes. However, it is a different calculation, and it's how it's calculated is, well, there's age considerations, there's health considerations, and then there's income or net worth considerations, right? So generally speaking, a life insurance company will consider you a working age person until you're around age 65, right? So if you're a 30-year-old guy or gal, you've got 35 more years to produce an income. So you take your income, if you're making $100,000 a year, multiply that times 35 if you're 30, and that's how much death benefit underwriting you can have. Did I say that correctly?
Yeah. That's an approximate wag.
And that's a swag.
It's a ballpark.
Right? I mean, it's fairly close.
Yep. The other limit. So that's the death benefit side of the equation, but there's also a premium side of the equation. Is there a limit to how much premium you can pay? In general, life insurance companies don't like to allow you to pay more than 25% of your gross annual income in premium. If you do, they're going to have more questions. Underwriting will have more questions, and you just have to justify it somehow. Maybe you have a lot of money in savings that could pay for that premium for several years, or maybe you have a business. Like most business owners, real estate investors, we all try to minimize our income, right? Try to get as small as an income as possible, which is great for tax purposes, terrible for going to the bank for a loan, just a conventional loan for a mortgage or something like that. But so there's other considerations we can take into account to increase what underwriting will look at as your annual income, right? We can take business income. There's some things we can do, but in general, 25% of your annual income gross is kind of what you're limited to right at the beginning anyway.
Right. Yeah. And in other words, you can't make $100,000 a year and pay $100,000 a year of premium.
Right.
Put quite simply.
There you go. Okay. So, but as far as IRS limits that they impose, on other qualified plans, no.
No. Yeah, they don't exist.
Right. Okay. Well, so how can I build this? This is one that comes up a lot for people especially people who get it. They read the book, they do their research, and they're like, oh man, I want to get this going, but I want to get it going yesterday, not 5 to 7 years from now. So they ask, how can I build this policy as quickly as possible to use for, maybe they have a big purchase coming up. Maybe they're going to, they have a roof that needs to be replaced and they have to do it out of pocket. So they got 20 grand. They got to do this right away, but they don't want to just give over that cash and pay cash for it and lose the ability to earn anything on that 20 grand the rest of their life. So like, how can I get this in there and use it right away?
Sure. Well, this is going to depend on the company that you are getting insured, getting your policy through, right? So some companies allow you to put in what's called like a single lump sum or a single premium on top of your whatever premium you set for your yearly premium or your monthly premium, right? So we do that a lot sometimes for this very reason. Someone wants to get their tithe in there or get the new roof expense, or in my case, before I pay that tax bill every year to the Fed, put it into a policy first. And anyway, so there are ways to get those lump sum inside a policy so that you can kind of jumpstart your system. And that's going to provide you a certain amount of death benefit for a certain amount of years, depending on how it's structured. So yes, the answer is it is possible. It just depends.
Yeah, it depends. And here's another one that really goes hand in hand with that, especially for real estate investors, which we had somebody comment on our YouTube video. They wanted a little more explanation and more deep dive into real estate and how this benefits them, which we'll get to on a future episode. But this question, I just sold a property and I want to stuff as much of this cash into a policy as possible, but I know I won't be able to do that next year or the year after. So can I do this? And the answer is yes. Just like you said, there's that lump sum option with many companies where we can do that. We can dump as much as we can, build as much room as we can in the first year. And maybe it would accommodate all of that cash that you just got out of that property, or maybe it wouldn't. You'd have some left over. In any case, yeah, we can max that out. And that's a great way to get that in there, get that working for you right away, and never lose the value of those dollars by just taking them, putting them in a checking account and spending it for, your other expenses in life. Put it there first, and then it's going to be working for you forever.
Yep. Perfect.
Yeah. When does this come up for real estate investors? Well, we know a lot of apartment syndicators, and what do they get? They get acquisition fees, right? So we're talking to one right now who says, hey, I've got 3 or 4 acquisition fees coming up in the next 6 to 9 months, I want to be able to put all of that cash somewhere because, I want to keep that. I want to build my war chest, which is what a lot of people are doing these days. Right now, June 2022, people are building their war chest to get ready for what's coming next. So that'd be a great opportunity to do that. Design a policy. In fact, maybe for the first, I had one client a year ago who said, hey, I'm selling, an apartment building every year for the next 3 years. So I want to be able to stuff, say, $50,000 a year for the next 3 years. But then after that, I only want my premium to be $25,000 or $20,000. So there's ways to design these. That's why it's so great, because it's so flexible, and it's case by case. It's tailor made for each person's particular scenario.
Yeah, I would generally say that almost anything is possible that you want to do.
Yeah.
That your imagination can come up with. What the examples we just talked about are quite simple, very common as well.
Right.
Dump a lump sum in there, and then there it is. You've got it. And they're very, those lump sums folks are very efficient too. You hear us talk about, well, the policy doesn't go cash on cash for the first 12 years or 10 years or 8 years or whatever it is. But those lump sums, those PUAs, are quite efficient, generally beyond 90% efficient.
Right. Oh, yeah. Very efficient. 92%, somewhere around there. So, yeah, you don't lose a whole lot of liquidity right then.
That's
and
right.
Then you gain it back very quickly over the next few years.
That's right.
How about this one? Can I insure employees?
Yeah. There's several different ways. We've talked about this in the past with some folks that we know. Take out key person or key man insurance on if you're a business owner, you have this key employee who if you lose them, there's going to be a downturn in efficiency to your business or profitability. So you want to be able to absorb that loss of income while you're searching for the next star employee, right? Maybe it's your general manager or your, whatever it is that function that person's putting at your, fulfilling at your company. So that's one way. Key person insurance.
Yep, that's a great one, and that's could be your highest earning salesperson.
Sure.
Right, and if something happens to them, then you're at a real loss for cash flow until they are replaced and that person's trained up, or you find another rock star salesperson. So, yeah, really, it's a gap filler, and it could pay huge dividends. And if that person decides to leave the company, you still get to keep the policy going. But it just creates so many options for you.
That's right.
There's another one that often business partners, listen up. If you are in business with somebody and you don't have a buy-sell agreement, first off, you need to put one in place. So your beneficiaries, your heirs, know what's going to happen with that business, so that and you can sleep at night knowing what's going to happen to that business if, God forbid, tragedy strikes you in your sleep or whatever. Now, second, if you have a buy-sell agreement, that's a great first step. But if you have no capital to back up that buy-sell agreement, it's pretty useless, right? So how that works is, really the easiest thing to do is both business partners will buy a life insurance policy on each other. They fund it, they own it, they control it. And if the other business partner dies before that business, is dissolved or they split up or something, then the other business partner cashes out, gets that life insurance income from that life insurance policy, and they can use that to buy out the deceased business partner's interest in the company from the family. So that's if you don't have that, you need it.
Yeah, I was gonna say if you don't have this in your business, you have the legal aspects. It's kind of, it's like, Dave. It's the same thing for just family people when you have a will. Or powers of attorney, right? Instructions, break glass, in case Paul dies, this is what's going to happen. Right? The truck goes to Anthony, the car goes to Carmel, whatever, right? Same thing with the business. And yeah, you explained that perfectly. And I would say if you don't have one of those, you must, and fund it with whole life insurance.
Yeah, absolutely. so that it will be there when you need it. And in the meantime, guess what? You get to access the cash value. You own the policy. You control it. You can whatever you want to do.
You could do IBC with it.
You do IBC with it. So there you go. Yep. Yeah, good. And then, so here's one thing I'm just going to add on to that. A couple weeks ago, a buddy reached out to me, just sent me an email and said, "Hey, Dave, I just told my significant other, I gave her your name and contact info and said, if anything happens to me, call Dave. And he will, like, he's an agent also. You know, I'm not his agent, so I can't get his policy paid out or anything like that. But he said, call Dave and he will help you do something with that money to ensure that it sticks around and is put to, you know, the best value possible for her and her son." So if you haven't done that, at least do that. Like, just send an email to somebody saying, "Hey, I told my wife, I told my husband, if I die, they're going to call you and you're going to help with the finances." Because chances are there's one person in a relationship who doesn't really keep up on the finances. It's not their thing. So they give that duty to the other person. So.
Yep, I think that's accurate for sure.
Okay.
Yeah, I mean, hell, we did the same thing with you. Tammy knows who to call.
Yeah, that's right. What about this one? This one comes up all the time. And it's usually an indication that people they haven't quite got it, right? So we know where they are in their knowledge level of the infinite banking concept, but
it's an indicator for sure.
It's an indicator, right? Just like when Paul plays, one of those old Earth, Wind, and Fire songs on a jukebox at a restaurant. I know that.
Wow.
Yeah.
I'm more of a Everly Brothers guy.
Okay. It's an indicator that, okay, he's one of these guys. Got it. Okay. So, everything's an indicator. So one of these questions that we get all the time is, hey, I contribute to an IRA. I contribute to 529 plans for my kids' college. Should I do IBC instead? And what do you say, Paul?
Yes.
Done. Next.
Final answer.
Yep.
No. Okay. I know where you're going with this. So, in case y'all didn't know, we do not script this. I mean, that's how good we are, right? No. So, my real answer is yes. And this is me in a nutshell, right? However, the answer Dave is looking for is no. You could do both, right?
Right.
You can. Once you understand how IBC, the process of IBC works, and how dividend-paying whole life insurance, the product through which to practice IBC, functions, right? You know that the first stop for your capital, whether it's your IRA contribution every year, your 529 contribution every year, whatever, should stop there first. It should be premium dollars first in your own infinite banking system. Doesn't matter how many policies you have. It could be 1, could be 5, could be 10. Doesn't matter, right? But the money should go there first, and then you do whatever you want from there, right? If you still want to contribute to a 529, great. But now you have dollars doing multiple jobs for you instead of just, I'm putting the money in the 529, and then, oh crap, the kid didn't go to college, and now I have to pay a penalty and taxes on that money that I have in there.
Right.
Wonderful.
Yes. So you can do both, but I like your first answer, which, we're not telling anybody to not do those things. That is your choice to do what you want. But as for Paul and I, the answer is yes. Paul, you choose to, and I choose to do IBC instead. We could do both. We just do this instead and have a different strategy for putting that money to work.
Right. Your goal should be to make too much money to put into a Roth, right?
There you go.
So there's a threshold for that. It's not that high anymore.
Not anymore with inflation. It seems a lot lower than it was a few years ago.
Yeah. And then the other thing I would say is, I thought I understood IBC when I first started, but nope. And you'll attest to this. I was still doing my TSP, maxing it, right, for the first probably a year into my policies, and then a separate person kind of like, "What are you doing?" And I was like, "I don't know." It was hard to shut off. So I understand the angst. I'm telling you, once you do it,
yeah, exactly.
It's a mindset, though. You got to be in the right mindset.
Yep.
Keep reading, keep studying, and then look around at what's going on.
Yes, look around. We talked about that in our last episode or the one before that. Like, look at your surroundings, look at the environment that you're in, and make some decisions based on that as well. You said, you almost got me cracking up here. You said, this is me in a nutshell. And anytime somebody says that, I just think of that Austin Powers. He's like, this is me in a nutshell. And that's all I can think of. So don't ever say that again unless you want me to laugh. So here's some things some clients say. Here's one. How much premium should I pay? So that's kind of the opposite question, or, how much premium do I have to pay? It's kind of opposite of that first question we asked, which is there a limit to how much I can pay? So, Paul, what do you usually advise to people when they say, maybe they do get it. Maybe they're like, I really want to do this. This makes so much sense. Help me figure out how much premium I can pay.
Yeah, I think there's a couple of different people that ask that question. One, who doesn't understand IBC yet. There's that person. They just don't get it.
Yeah.
Because my answer is going to be, well, as much as you can possibly afford. What's 25% of your income? That's my answer. The other person is just, they want to be told, hey, the only limit is 25% of your income, right? That's the limit. So that's the goal. But they get IBC. That's the other person. I understand IBC. I want to put as much into this as I can. How do I do that? And then we custom design a series of policies or one policy or whatever to accomplish that goal.
Yeah. Okay. Why don't you take the one about committing more money on an annual basis? I didn't really understand that one, but I think you have a better handle on that question.
The mortgage one?
Yeah.
Yeah, so this guy's very smart, engineer, listener. So Brent, if you're listening. So this is what he put in an email. Now I'd be talking about premium, right? That's the context. Talking about premium level. I would be committing more money, premium, to that, meaning a policy, on an annual basis than the principal and interest on our current mortgage for a time period longer than our mortgage would last. So let's say he's got, 25 years left in his mortgage. He's going to be paying on this policy until age 75 or age 95, whatever, age 100. So my response to him was like, yes, that's true. In fact, I pay more than double what my mortgage is in premium every year. That's the whole idea. Pay significant premium so that we can, one, Nash teaches us, right? Don't do business with banks, right? That's one of his 5 principles, right?
Yeah.
Don't do business with banks. In order to cut out the banks, you can't pay $100 a month in premium.
Right.
Right? You got to pay significant premium to build your own financing system through this product. So yes, you might be paying as much as your mortgage or more than it, and that's fine, right? That's
right.
Totally that's good. So it was just funny. It was just understanding and growing pains and learning the why and getting in the right mindset. That mindset shift is hard. It's difficult. It's not
it is
normal to pay a lot of premium for as little death benefit as you can get. It's very atypical.
Right. And you said it, but Nash said it this way: don't be afraid to capitalize.
Don't be afraid to capitalize.
That's really what it is. Pay a lot of premium. I tell people every time I talk to somebody and we get down to the premium question, like how much should we put in as a premium? How should we design this? I say it really comes down to 2 things. It's got to be manageable and meaningful. So can you manage that premium? So we take a look at their overall holistic finances, where the cash flow in, cash flow out. Where's all the cash flow out going? And then can we redirect that? What of that can we redirect? What of it can we not? And we figure out, okay, we can put this much here, and this is what's manageable for you. But let's take a look and make sure it's meaningful also. So if you're redirecting $100 a month, $200 a month, that's manageable. You can do that without losing a wink of sleep. But is it meaningful? No. It's going to take you decades to build anything useful that you can use to replace a bank, a commercial bank, right? So it's definitely got to be meaningful.
No, I love that. No, it's a perfect way to describe it. I think James says this sometimes. Your premium level is probably going to be uncomfortable if you're paying appropriate premium relative to your income. It's going to be uncomfortable because you know nobody that's doing that.
Yeah, and since I heard him say that, I've started telling that to people. I'm like, okay, now, because sometimes they're like, well, what is manageable? define manageable, and I say, well, it's an amount you can do. Think of the amount that you could do comfortably. Now add more to that until you get slightly uncomfortable and you're like, this is going to be tight. That right there is your premium.
There you go.
Yeah. Because they quickly realize it's actually not as tight as I thought it was going to be when I started, right?
It's not, and you, I think you end up getting rid of some waste. I've had clients in the past like, why am I doing this? Why am I spending $600 a month on this? And it goes away. I've had clients double their premium in 6 months.
Yeah.
They set a premium level right out of the gate, lump sum, manageable monthly premium, and then 6 months later, I need another policy.
Yeah.
And luckily he's a super healthy guy, super preferred, and doubled it.
Well, and if he would have locked in his insurability through a convertible term policy the first time, it would have been even easier. And you've done that a few times where people just say, hey, I'm ready to convert, $500,000 of that $3 million policy. Let's convert $500,000 now. And paperwork, and it's done.
Yep. We're doing that right now with a guy. And of course, he's only 31. He's super young.
Yeah.
But gonna pay significant premium relative to his income. So, yep.
Good. And did we already do the convertible term? Yeah. So episode 18, if you want to listen to more about the convertible term policy, which is a huge value add and something everybody should really heavily consider, take a listen to episode 18.
Yep.
Here's a good one. So considering the interest rates right now, the Fed bumping up that commercial loan interest rate or the bank loan rate and all that, and interest rates looking like they're climbing. Mortgage rates have doubled in the last couple months. What about the interest rates? Like when we take a loan from a life insurance company, we're paying them an interest rate to borrow that money because it's their money we're borrowing because we're not borrowing our own, right? So we're paying interest. How do we see the loan interest rate being affected? And conversely, how is this going to affect the dividend rate that life insurance companies pay, from our opinion? So what would you say to that?
So the second part of that, the dividend rate, that's complicated.
Yeah.
That's the higher ups of the company that need to answer that. But generally speaking, there's a lot that goes on in calculating the dividend that a mutual life insurance company issues every year. And they have short-term money that they're counting on, they have long-term money that they're counting on, and there's everything in between. That really depends. Generally speaking, if interest rates were like they were in the 80s, right? I think we're kind of still enjoying some of that, perhaps. Dividend rates are going to go higher, right? So dividend rates, if the Fed's rates are high, dividend rates are going to be high generally, but it's going to take, a period of time for that to catch up.
Yeah.
Right. Policy loans. I don't know when we will see the companies increase. Currently, most of the companies are somewhere in that 4 to 6% range, and they've been there for a while. Interest rates have been low for a while, and that's generally been the charge of interest at generally 5%. Right? When we'll see an uptick, gosh, I don't know. I mean, I don't know if you have a stronger opinion. I'll be honest with you. I don't really care.
True. Yeah, that right there is a
I
great
value my
response.
capital at 10%. It's going to be less than that. The policy loan rate's going to be less than that. That's what I pay back my policy loans at anyway. I pay them back as fast as I can. I'm paying back at a high rate, right? So I don't care if the policy rate goes from 5 to 6 or 5 to 7 or I don't care.
Yeah.
Maybe that's not the best answer, folks, but once you understand what we're doing here, you'll say the same thing.
I think that's a great answer, man. I would agree 100%. What are the rates going to do? The loan interest rates, the dividend rates. It's kind of like watching, that question it's kind of reminds me of watching like Sports Center. Like these guys talking about like, oh, well, what will Aaron Rodgers' impact be on the Green Bay Packers this year? Who knows? Nobody. So I don't care what you have to say because what you say means nothing and has no weight on what is actually going to happen. So your answer is perfect. Like, we don't know, but we don't care either. These companies have paid out dividends for over 100 years straight that we use. So I'm pretty confident they're going to continue to pay out dividends. I'm very confident in that. There is going to be a dividend rate. There's, in my opinion, and the loan interest rate. You're right. I don't really care because right now, yeah, the value of your capital is 10%. Man, with inflation, with interest rates climbing, maybe we get back to 1980s levels, and the value of our capital is going to be much higher than 10%.
Yeah,
it just
no
means
question.
We're going to be going only for opportunities where our capital is valued at that level. And it's always going to be at a higher level than what we're borrowing at. Always, or else it wouldn't make sense.
Yes, of course. Yes.
Yeah. So, there you go. Well, all right. Well, we hit our time limit here. I think we got a few more questions, but we'll just save them for the next episode unless you have any parting shots you want to add to any of these.
No, I haven't done this parting shot in a while, but if you're listening to us and you want to reach out and stuff, we're going to tell you to pick up Becoming Your Own Banker. Probably the case for IBC. We're going to have you listen to some episodes. So if that's you, please pick those things up, and by all means bring your questions to the table. But don't work with anyone that hasn't read the book.
Absolutely, and I love that you hit on that all the time because we've had several people reach out to us, and my favorite type of people, it happened just recently. Somebody said, it was a lady, she said, hey, I read the book, I listened to your podcast, I got the book, I read it, I just finished it, so I'm ready to schedule time with you. I'm like, outstanding. That's great. So I'm really looking forward to that conversation because I know she'll be at a different level than somebody who's coming in cold will be at. And it'll be more beneficial on both sides.
Yeah, please. There is some good content out there, but I had this conversation today. People are out there. Well, I've watched some videos on YouTube, and of course, I have no idea what he's watched. I know he's a good guy because we had a conversation, but I don't know what he's watched, right? So I got to him early enough, so he hasn't probably tainted too much. But
yeah,
you know, there's good content out there, and there's not good content, and there's noise out there too. There's a lot of it.
Lots of it. Yeah. So check out. I've got some videos out there on my YouTube channel. And then, of course, all of our podcasts are on Wealth Warehouse YouTube channel.
I use your little 4-minute video all the time.
Yeah, it's I might be biased, but it's the best 4.5-minute explanation I've ever seen on this concept.
And you filmed that with like an Obama phone.
I filmed it with a Google Pixel.
Yeah.
Yeah. The Google, still, I think the Google Pixel was far and above way better than any iPhone I've ever owned. But I'm back to the iPhone because there's just some things I don't like to live without. So we'll leave it at that. There's my 2 cents on that.
I've said that in a couple episodes now.
Yeah.
So
all right.
funny.
Cool. Well, all right, Paul. Hey, good catching up, bud. And we'll talk to everybody next week.
Hey, thanks for listening, everybody. If you'd like to have a conversation with us to see how you can become your own banker, or if you have any questions or topics you'd like us to tackle on a future episode, please send us an email to davidandpaul@theibcguys.com.
And subscribe and leave us a review if you're on Apple. Follow and leave us a 5-star review if you're on Spotify. And please share this with your friends. We'll see you next week.